We do have a downturn. I think we can all agree on that right now. And a lot of investors are saying, where do I go in a downturn? What does active management offer you that perhaps passive does not?
Well, it offers you a lot. There's no doubt that there is a place for passive and has been a huge place for passive. But when you had 15 years of super easy money and all boats rising, then you can run a momentum cycle, and many, many people did, and that was a large part of the driving growth of passive. Now, when the cycle has reversed and the tide's going out, and as we can see today, we have the NASDAQ so far this year down 30%. We're in a bear cycle. In a bear cycle, you want to be very selective. You want to be able to make decisions to be defensive. Essentially, you don't want to own everything, and passive is owning everything. So there is our role as an active investor is to be able to answer the question of where should I go, what should I do next, how can I preserve my capital and be in a position to grow capital when there is a more conducive environment.
So, Stephen, help some of our investors right now on that very question. As you're seeing growth subdued and some concerns about even recession here in the United States as well as elsewhere, and at the same time you see inflation really, if not out of control, looking in that direction, where are places you can go that's different? Where can you zig when others are zagging?
Yeah, well, the very important thing to recognize for every investor, and it's where we begin, is that you should be diversified. It's the first step to ensuring that you're actually never going to have massive concentration risks. So you should be diversified. And you should recognize that throughout your investing life, there's always the cycle. Now, there have been 14 bear cycles since 1929, and those bear cycles, on average, last 20 months. So what you've got to think about is, yes, right now you're seeing inflation, very, very hot, and you're seeing central banks all across the world. The Fed yesterday was 75 bips, and overnight the Swiss as well. Everybody raising, tightening the cycle to tackle inflation. So what should you do? Well, you want to be in a defensive position. You think about equity with strong income, long-term quality, defensible business models with the ability to price through in higher input costs. You also got to think about, if you think more on a more macro level, which countries are going to be accommodating whilst the US in particular and Central Western Europe and the UK are tightening. China is actually a counter to that. China was struggling whilst the US was thriving, and China is actually going to be accommodating whilst the US is tightening. So in a diversified portfolio, which is very important, you can think of those places as being able to have a better prospect of growth whilst there is such an effort to reduce demand, which is clearly what's going to have to happen. It's beginning to happen, and it is going to happen in the developed economies.
So let's pursue that just a little bit, China specifically. I think I understand at sort of a macro level, 40,000 feet, that China is probably going to be loosening at the same time the United States and a lot of other places are going to be tightening. I understand in macro. At the same time, China is a big country and a big economy. You have to be pretty careful, don't you, about where you invest in China?
You absolutely have to be, and you really have to have people on the ground. So we do have and have had for the last 30 years. So understanding the cycle, we're very, very selective in terms of where we would invest. And again, that's about, you've got to peel the onion and figure out which businesses can thrive. Well, businesses that are able to supply and service consumer demand in China, of course, are some of those businesses, because they're going to have high exogenous demand. Those are some of the businesses that you would want to be in. You wouldn't want to be in right now in real estate. Of course, those issues are well known. There are areas of tech where you do want to be invested in China. China actually is producing a lot of clean tech for the energy transition. And the energy transition, as we know, if you think about, yes, today we're very preoccupied by inflation, very preoccupied, and the media is full of a tightening cycle. But climate change hasn't gone away. I think for the balance of our careers, the energy transition is one of the single biggest opportunities. It's a risk for the planet, it's a risk for individual businesses, and it's one of the biggest investment opportunities that we will face. So being able to identify within that energy transition which technologies, which clean technologies, if you think about solar, if you think about wind, if you think about tidal, but if you also think about sustainability of food supply, if you think about energy management systems and software systems, those are areas that we know that when you look through this cycle will have high demand. And we're investing in those. Of course, sustainability lies at the very core of what we as a business are doing. And it's not a marketing thing. It's about risk management. It's understanding the true environmental, social, and governance risks associated with any particular investment.
Stephen, one more on China, if I could. There's political risk in any investment anywhere in the world, but certainly there is in China. We've seen some, for example, investors in high tech and sort of the big tech over in China really get burned over the last year or so. How do you take into account political risk when you do pick your spots in China?
It's incredibly important to understand that in China, politics drives policy, policy drives progress. So you need to understand these episodes of reform. In fact, as you know, I've spent the bulk of my career living and working in the Far East, living and working across these different investment categories, and I have seen many episodes of reform where Beijing allows the capitalism with communist characteristics to grow and thrive, and then it resets because it sees inequities building up. Now, tackling inequities in exactly the same way that China did last year in terms of tech regulation, in terms of education regulation, tackling inequities is by definition a good thing to ensure that you can continue to grow. That's actually Beijing's motivation, to ensure common prosperity. Common prosperity means that you've got to be able to have an economy that can, the ability to lift hundreds of millions of people out of poverty and into the economy. They're not going to stop doing that. They want to continue doing that, but they want to address inequities. So what we have been doing is understanding where in those episodes of reform, how long will they last, what is the intent of the regulation, and what are the consequences of it, and see through that cycle. And I believe that China has actually signalled that we've done the reform that we wanted to do. So they've been signalling. Now, we know today China's still locking down. China's still, Shanghai and Beijing are experiencing lockdowns at the moment because they're still pursuing a zero COVID strategy. Now, we also take a view that at present, that is the right policy for China. So you've got to take a view of many factors. It's the macro factor, but then the individual industry factors, and then invest accordingly. It's not just about China, so you have to take a view that some investors are taking a view that we're entering a bipolar world. And this is, you're going to have a US-centric economy in the world and a China-centric economy. And within that, there are other countries that clearly do represent an opportunity. One of them is Japan. So if you think about Japan, if you look about the weakness of their currency, but if you think about the fact that as some investors take the view that there's a China-centric supply chain emerging, which we're seeing, then that does represent an opportunity for Japan and for the technologies in Japan, and particularly in the energy transition, we view that as an investable area too.